Welcome, everyone. Today I have with me Laurence Black. Laurence is the founder of the Index Standard and an index advisor to Professor Robert Shiller. The Index Standard is a company that provides ratings and forecasts on indices. Earlier in his career, Lawrence instigated the Shiller Barclays Index with Barclays and Professor Shiller, and he has appeared in multiple media outlets and is, for me, one of the thought leaders in the index space. Prior to that, Lawrence was a managing director at Barclays, and where he held the position of global head of QIS, origination and development, as well as other roles. Lawrence, thank you so much for doing this with me. I know that you have a busy schedule, so I appreciate that.
Tiago, it's great to be here, and I think this is a long overdue industry resource that's needed. So congrats on starting this venture, and good luck.
Thank you. Look, I think it's very important, right? Because this is a structured products podcast, but you're one of the first episodes, and I think what is very relevant, right, is that I was even thinking before this conversation is that there are not many ways to directly invest in any index except with structured products, and that means that the indices itself, as underlying for the structured investment products, has a massive market share, over 60% globally. Lawrence, you have a lot of experience. Can you tell our audience how have index-based structures evolved throughout the last 15 years?
Yeah. So, I think we've seen a lot of evolution. And if I think back to, let's say, 15, 20 years ago, you would see, really a very simple index maybe housed in a risk control feature. And I think the risk control feature was the key thing. And since then, it's really evolved. What I would say is you've seen people use kind of better allocation tools like mean variance optimization. Then you've seen people bring in sort of signals, and that might be using sentiment signals to go long or short risky assets. Then you've seen long short indices. And in the last couple of years, we've seen artificial intelligence being used. And then intraday risk controls being a new feature. And I think, those last two techniques, they really draw on better technology to try and deliver something interesting for the end consumer. But if I sort of take a step back, what I would say is what we've really seen is a democratization of indices. Because in a way, a lot of those techniques that I described earlier, those were really only the purview of institutional investors. And we've really now brought them into the world of structured products and high net worth individuals. So they've been able to access these really technical allocation processes that are hopefully good for their portfolios.
Let's start, right? If you go back at the beginning, right, and it's sad to say that I still remember all these indices before the 2008 crisis. A lot of them were just, big benchmarks like the S&P in the US, Eurostoxx 50, PSI 20 in Portugal, in my case. Why do you think that structured products use the indices as a way to sell structured products?
So I think there's a couple of reasons. For me, the number one thing is really about controlling volatility. That's really been the trick that what we've needed. And secondly, you've needed to control the volatility because since 2008, as you mentioned, the zero coupon bond, which is the heart of every structured product, that just costs you so much. So you really needed a cheap option, and these risk control indices were able to deliver cheap options and then really help the whole construction of a structured product.
And what we've seen recently a massive growth in terms of percentage of proprietary and QIS indices. You mentioned some like AI, but also not like recommend indices, which we'll have an episode just about that, or using futures, multi-asset. What's driving this growth?
So I think there's a couple things. For me, number one is institutional investors are already kind of driving this, and they want interesting and innovative indices to sell to their clients. So for me, that's the number one thing, right? They really want something, with bells and whistles that they can position for end clients. So that's been a big driver. The second thing is, I would say if you're a bank hedger or a trader, and you're going in competition with 20 issuers pricing the S&P, that's like picking up pennies in front of a steamroller. And it also puts a lot of sort of risk, similar type risk in everyone's trading book. So QIS indices, they do a couple things. One is they help diversify the risk. And then secondly, the bank is pricing, generally the only one pricing on that index. So it enables them to kind of earn it's hopefully a fair margin while still delivering something innovative that can be packaged into a structured product. And then finally, I think the other thing is the need for controlled volatility, which provides stable product parameters. So if you have a subscription period, the bank can hold that price during the subscription period. Or if you're thinking about the kind of insurance space, you want to have stable renewal rates throughout the life of a product. So you really need that controlled volatility to enable delivery of that consistent power rates.
Now, it's very important that they say, right? Not you or me, we're not here selling indices on structured products, right? We're here just to provide some knowledge. But from your view, an independent view, someone who built these indices for the last 20 years, what makes a good index?
Yeah. I've got a couple of thoughts, and at the Index Standard, we've done quite a bit of analysis. So let me kind of start off with some high-level thoughts. I think for me, what you really want is simplicity in design. Now, that's very hard to deliver because you've got a lot of asset classes, a lot of things going on. But I think you really want clean and simple design. You don't want too many parameters. Secondly, what I like to see is we definitely would like to see some rules being displayed that the end client can understand or at least get a sense of what's going on. Then I think for me, you kind of want to draw upon some established principles. So those principles might be academic research, or that maybe that index has been used in an active fund and that fund has been around, and you can have a look at the track record. So you want something with a track record that can demonstrate why this index is going to perform in the way it's been designed to perform. So those are a couple key things. I think the other things you want to look for, you want to make sure everything is truly transparent and algorithmic, that the underlyings are liquid, they're tradable, that there's going to be no potential issues in the future. I remember a couple of years ago, there was an ESG index that had two small New Zealand stocks. And when this index got to be a couple $1 billion, it was a problem. So you have to think about liquidity, tradability. Those are actually key things sometimes that people tend to overlook.
So are those the common pitfalls in structured products indices, or are there others that, let's say investors, advisors who are listening to this should take into account?
Yeah, I think there's a couple things. I mean, one thing we see kind of repeatedly is just too much complexity. So let me give you an example. Sometimes we might see an index that has maybe 8 sub-indices, and each of those sub-indices might be long-short indices. They might have multiple techniques going on within those 8. Those 8 indices might be combined using yet another sort of complex technique, and you'll get a back test that looks like a 45-degree line, and it goes live, and it can just be disappointing. And I think in that case, the index is just too complex, too many signals, too many things going on. So that's why I tend to look for simplicity, kind of keep it simple. I think that's a good way for an index to perform well. And at the Index Standard, what we do in some of our processes, we evaluate the complexity of each index. And what we found is that the more complex indices don't tend to do as well. It's generally the simpler indices tend to do well.
It's also important, right, to think about all these type of indices, right, that try to generate some type of alpha or better Sharpe ratio due to the volatility control. They also perform well in different market scenarios, right? And
Exactly.
that's something we saw, right? Especially with after COVID, the ESG indices that been underperforming. So, Laurence, how do you look at how these different indices and different exposure that they provide work with the macro environment?
Yeah. So what we're trying to do, I'm always like trying to make sure, are these indices doing what they're supposed to, and are they performing? Because what I would rather my mother bought a risk control index than a regular benchmark, right? They're actually better and safer. So what we've done at the Index Standard over the last couple of years is a couple of things to kind of try and evaluate the effectiveness of these indices. So number one, we went back and we created a risk control index going back about 120 years. And then we compared that to a benchmark. And what we found was that the benchmark index only outperformed on a risk-adjusted basis 2 out of 12 times. So the risk control basis over 122 years, and we looked at decade by decade. So in 10 out of those 120 decades, the risk control index outperformed. Now, what we were doing there was we were looking at the Sharpe ratio. And since then, we've kind of come up with a new metric that we like. And really, what we call this metric, it's the TIS ratio, and it really it's the bang for your buck. And what we do is we look at the payoff divided by the premium. So, i.e., what you got divided by what you paid. Now, we've gone and analyzed the risk control indices and compared them to a major US equity benchmark over the last 10 years. And we found that about 40% of risk control indices outperform the S&P. So that's actually pretty solid because number one, think about it, the S&P's had a fantastic last 10 years. And then if I look at a similar metric, how many mutual funds have outperformed the S&P? It's only about 12% in the last 10 years. Actually, risk control indices have done well, but let me add a kind of a huge but. The huge but is what we find is that people don't compare the S&P to the risk control index in the proper way. What they'll do is they'll say, hey, the S&P was up 10%, my risk control index was up 5 and it underperformed. People don't realize that they need to look at risk adjusted returns. So we as the industry, we've got to help educate people and let them know that which is the right way to evaluate these indices. But let me just make one sort of balanced observation is that one thing I would say in 22 and 23, we saw a lot of multi-asset indices in the risk control feature underperform. Now, all these indices are built to be really built in on the concept of diversification. That equities and bonds will go up and down at different times. However, as you know, in 22, bonds and stocks went down and a bit into 23. And that's left a bit of a sour taste in many people's mouths. But apart from that, over the long term, they generally have done well.
Now let's talk about, right, because you mentioned that you have this new way to measure, right? And of course you say premium, right? But if it's S&P risk control so on, that's very easy to know what's the premium. But we've seen now not only risk control on benchmarks, but we have multi-asset, we have single stock or baskets or themes. So how does it work? How can you make sure that it's not your S&P 10% risk control or 5%? How can you make sure that on other type of indices you're still getting your money for the buck?
Yeah. I mean, so what we do at the Index Standard, we actually measure the payoff, and we'll actually look at the positive payoff of an index, try and replicate, let's say, capital protected structured product or a fixed index annuity. And then we'll actually go price up the option of that underlying index. And for the vast majority of the options, we can figure that out. The team has all quantitative team, so we can price these up. So we feel like we've got a good handle on that. And you're right, there's one or two that we can't price up, but I'd say the vast majority of them we can price up. So we can really compare them on this metric that we look at the payoff divided by the premium. We think is a smart way to evaluate these indices.
Okay, and let's talk about it, right? Because for advisors and end investors, are these indices and structured products as well as annuities as a wrapper suitable for long-term investors?
I absolutely think they are, because let me take a step back, even a higher level, because if I look at, let's say, structured products and annuities, these are what I would call part of your alternative set. And the other alternatives you have are private equity, private credit, and let's say VC. And these three areas have been super hot. There's been a lot of activity. Literally trillions of dollars have gone into these assets. But I think if I could be critical around private equity, private credit, you could say it's volatility laundering. They don't really mark to market. So I would say, to me, alternatives that include structured products and annuities, they actually really provide true diversification. Because let's say you had a capital protected note over the last 2 weeks. When Trump announced his tariffs, you didn't have to worry so much. You knew that you were capital protected. So I think that these two asset classes, structured products and insurance, have been underappreciated to an extent. And I think hopefully over the next couple of years, we will see people appreciate the sort of portfolio effects that they provide, true diversification, capital protection, and actually increase them. But, I'm actually encouraged because we've seen structured products and annuities in the US growing at over 20% for the last 2 or 3 years. So people are starting to gravitate towards them.
So we can also discuss the side, talk about transparency and value for money. This is a topic. Value for money has been very fashionable now in Europe with the retail investment strategy, but as well as in the US in the past. That was raised by some of the regulators. How important is disclosure of methodology? How important it is?
Let me answer that in two ways. Let me answer it from my personal belief way. So, from that first perspective, I think we're here to deliver good products for our clients that perform well, right? That's why everyone in this industry should be here, because if our clients do well, we'll all do well. So, with that in mind, you really want to sort of have some very fair and clear disclosures, right? I think that's the second aspect. You've got to be fair and clear. And the second point, at a very high level, is I think you want to make sure that people understand what they're buying. So it's incumbent on us as the industry to educate people. We want people to understand how structured products work or how these complex indices work. So we've got to have the disclosures, you've got to have the education and the videos to help the industry, to help the advisor, to help the end client understand what they're buying so that hopefully they can do well. And if they do well, volumes will grow and we'll all do well as an industry.
Okay, thank you. I do want to have a quick answer here. If you look at the past 15 years, can you tell me one index that you wish that you have created?
I would say for me, the JP Morgan Efficiente Index is the one. That's the kind of granddaddy of this industry. It kind of kicked things off. It's performed actually very well over time. It's got a good live track record, and I think anyone who's designing indices, that was the forerunner for us. So that would be the pick. But of course, designing a benchmark would have been fun as well.
So if we talked about overrated, underrated index strategies, you don't need to select one index. What are the strategies that have been overrated and the one that you really think that is underrated?
I think simplicity has been underrated. Just keeping it simple has been underrated because everyone wants something new, fancy, complex, some shiny bells and whistles. So I think anything with lots of bells and whistles is kind of being a little bit overrated in my eyes.
What's the most exciting trend in indexing for the next 5 years?
I'm very excited because I think there's a lot happening. So for me, I really like this intraday risk control technique. I think that's proving to be very effective. And I think with new technology, new data, and artificial intelligence, there's lots of scope to improve on that technique, but also maybe expand it as well and bring in some of this new technology to create better indices for our end clients.
Talking about, right, we were talking about market cap, we talked about the risk control, and you talk about this new type of indices. But what about thematic? Is trends in thematic indexing something that you're looking at? What's interesting over there, and what's not interesting?
But I think thematics are always kind of unpopular. They're easy for the end client to understand. So, I remember 2006, we did some green indices, and those have kind of been reborn as ESG indices. So I think that the themes, you'll always get the popular themes. And, most recently, it's always related to sort of new technology, new design. So more recently, it's really been artificial intelligence. But, I think for me, I'm actually kind of really interested in a theme that's been around for a while, but I think it's going to get a second wind, and that's robotics. I think once these robotic companies start to deliver robots that can help in the home, vacuuming and so on and so forth, I think that actually is going to be a big trend over the next couple of years. So I'm pretty excited about that one.
So what about AI? It's been around, the first index on AI actually was released 4 years ago. Is AI popular? Is AI something for advisors to look at?
Yeah, I think it's going to be a great thing, and it's going to really help the productivity of humans and mankind in general. But I think with new technologies, it's tended to get overhyped. So let me give you an example. I've done some work with Professor Schiller, and we've gone and looked at previous new technologies. So the steam engine was invented in 1760, but 100 years later, you had the steam engine era. Then you had the light bulb, which was invented in the 1880s, and in 1920, you had the light bulb era. And then you had the personal computer was invented in 1971. And then you had the internet era in the 99. So my point is, it's been at least 3 or 4 decades before you had a new technology that was fully sort of embraced and embedded and society was able to gain from it. So I think here, we've all got very excited about AI, but it needs to sort of get its way into the real world before it becomes fully sort of effective. So let me give you an example. If you have a factory, you need to maybe automate your whole factory, have little robotics measuring everything. Then you can use AI to optimize your factory. Then you need to change the layout. So that's an example. That's going to take a couple years. So I think the hype has got very big and the share prices have got kind of overpriced. But I think ultimately it will be a transformative technology. It's just going to be a couple of years before we really see the industrial uses.
In terms of advice for distributors and advisors, when they get these proposals from the banks or from their wholesalers, from the private banks, what advice would you give for them to evaluate the index?
Yeah. So I would say a couple things. Firstly, you really want to see a set of high-level rules. That's the number one thing. And then you want to try and apply some common sense to that. Do those rules seem to make sense to you? Are they based on some academically validated factors? Or is it based on some kind of mutual fund that's been around a while? Or if it's a multi-asset index, go and have a look. Are those underlying components, have they been around for a couple years? So you want to really evaluate that. Secondly, you want to see if there's some live performance. How does that live performance look compared to the back-tested performance? You know, if there's no live performance, you want to go and have a look at that back test. And if that back test is just at a 45, you know, you should probably be a little bit skeptical, because no index is going to be able to deliver a 45-degree line. So I think you have to have a little bit of skepticism, dig into it, look in the rules, and use some common sense. And I think you can probably come to a pretty good judgment.
At the end of the day, there are no free lunches, right? What you're getting is exposure or slightly different exposure or different risk level.
Yeah, exactly right.
So what's next for the index standard?
Well, you know, at the index standard, I think we're just trying to conquer the US, and then we'll be looking to expand into other regions. You know, in the insurance space, we're doing well. We've probably got about over 15 insurance carriers are our clients. We've probably got 25 to 30 distributors, and now we're starting to work with some of the banks to supply them with some of our data. So we're very happy with the progress we've made, but I think for us, we're looking at Europe and Asia are the next two big opportunities for us.
Look, thank you, Laurence. We really appreciate you spending the time with us. And if you have any questions to Laurence, feel free to reach out. I'm sure you'll be happy to answer any question. So thank you, Laurence. Thank you,
Hey,
everyone.
this was great fun, Tiago. Thanks a lot.